Welcome to Beyond the Comfort Zone Talking Shit with KING-KAMBUF. You have brought us a monumental stack of source material today. We're looking at the high-stakes financial news and reports for Wednesday, December 10th, 2025. This is our deep dive into the Reserve of KAMBUF Financial News and Reports Magazine, Weekly Market Digest and Investment Analysis Edition, Daily Report.
And that date, December 10th, was, well, it was a masterclass in market psychology, all driven by hard data. We're looking at the immediate closing bell analysis right after a critical Federal Reserve policy decision. And for you, the learner, trying to navigate that emotional snapback, the initial euphoria, then the sector decay that followed, and all the specific buy-sell signals, it can feel like you're trying to read a map during a lightning storm.
Right. And that's our mission here.
Right.
We're going to take this detailed EOD market report and the weekly digest summary and just provide a clear, actionable map. We're trying to find the signal in all that noise and that immediate post-Fed volatility. We need to understand precisely what happened, why the major indices rallied so hard right off the announcement, and then, this is the crucial part, why they gave a lot of it back and led to these profoundly mixed closes.
It's the core conflict in these reports that's so fascinating. On one hand, you have data showing this immediate, powerful, bullish technical action. It's driven purely by macro relief. The analysts are calling it the Fed cut fuel rally. But at the same time, you see this deep underlying sector anxiety and really concentrated profit taking. We have to help you understand the precise narrative shift that happened that afternoon, how we moved from broad index performance, fueled by the headline, to this sharp stock-specific rotational strength.
And that rotation is where the strategic capital was moving.
Exactly. That's where the money positioned itself.
Okay, let's unpack this immediately. We are jumping straight into the content, the headline news. The one that every trader, every analyst, every strategist had circled on their calendar, it finally arrived. The Federal Reserve delivered a policy rate cut of 0.25%.
A quarter point.
A quarter point.
Mm-hmm.
Now, as the report notes, this was widely expected, but, expectation rarely matters as much as the confirmation of the action and, maybe more importantly, the tone of the messaging.
The market almost universally rallies on confirmation. Assuming the language doesn't create some new fear.
Right. And the market scoreboard from that EOD report, it just shows that immediate bullish response. We saw the S&P 500 shoot up. It closed up, plus 0.7% at 6,886.68.
And it missed its all-time high by just a few points. A truly staggering performance right out of the gate.
And the Dow Jones, it ripped nearly 500 points higher. It finished the session up a full 1% at 40,057.75.
Also within about 200 points of a record. Just incredible strength.
But the real conviction, the sign that this wasn't just short covering in a few large caps, that came from the small cap complex.
Ah, the Russell 2000.
Yeah, the Russell 2000, represented by the IWM ETF, was up a really healthy and I think market validating 1.32%.
And that confirmed it. A clear risk-on tone was permeating beyond just the mega caps, and that signals confidence in the broader economy.
So why the initial aggressive ramp when the cut was basically priced in? That gets to the classic dovish read, right?
It was entirely about removing the uncertainty. The language from Powell's press conference was absolutely key here. The report says it was less aggressive about shutting the door on future cuts than many feared.
Okay, so it was about what he didn't say.
Precisely. Traders were braced for a worst-case hawkish scenario where Powell might have come out and said, this is a one-and-done move, just a little insurance cut. Instead, he left the door open for ongoing, data-dependent easing, and that immediately removed those worst-case hawkish scenarios from the table.
And the market could just inhale the relief and the promise of continued liquidity.
It was a green light.
And this is huge, but here's where we need to look beyond the headlines and really get into the nuanced analysis that the KMBUF Reserve provides. The report highlighted a critical detail, a kind of structural asterisk that just screams instability and long-term policy friction. The vote. The vote was 9-3.
That 9-3 split it's not just rare, it's a genuine warning signal. In previous periods of major policy pivots, the FOMC, they really strive for near unanimity. They want to maximize the impact and the certainty of their actions.
So having 3 members actively dissenting on a major rate cut.
It tells you the internal debate is fierce. Absolutely fierce.
So who are these 3 dissenters? What's their main worry here?
Well, the daily report doesn't always name them explicitly, but we can infer their position from their known historical leanings. These are the hawks. They are deeply concerned about cutting too fast.
They're worried about inflation coming back.
Not even just the current metrics, which have cooled, but about reigniting structural price pressures down the line, especially, with the market already performing so strongly. They likely argued that cutting now, when the S&P is staring at an all-time high and unemployment is low, that it just provides unnecessary fuel for asset inflation.
And the majority of 9, the doves.
They're the ones worried about tightening financial conditions for too long. They're the ones who fear triggering an unnecessary recession by keeping rates restrictive when, growth might be decelerating under the surface.
So this 9-3 split means the Fed fired a major macro bullet, extending the bull run's life.
But they signaled a deeply divided house while doing it.
The implication for you, the learner, is just profound then.
It really is. That split suggests future policy guidance is going to be highly volatile, utterly data-dependent. Every subsequent economic report, CPI, jobs, retail sales, it's going to immediately swing the balance between those 9 for easing and the 3 for caution.
So it tells us we are not in free money mode.
Not at all. We are in the tactical liquidity management phase. The consensus is gone.
The Fed's action was a short-term gift, but that split vote basically guarantees long-term volatility in rate expectations.
Exactly. And for traders, this means you have to be aggressive with your stops. You have to be prepared for sharp reversals if future data happens to favor that hawkish minority.
And we can't forget the backdrop here, the seasonal tailwind that gave this move so much power.
Oh, absolutely.
We are deep into December, which, statistically skews positive. This is the prime window for the classic Santa rally.
The seasonal playbook is real. It's a real phenomenon. The major indexes, S&P, Nasdaq, Dow, they all have a statistical bias for moving higher into the year-end. So this immediate rally, driven by the cut, it fit that script absolutely perfectly. It validates the structural trend, and it forced short sellers to cover, especially those who were betting against a year-end rally fueled by Fed easing.
But wait, here's the puzzle. If the market inhaled the liquidity relief so strongly, and the seasonal trends are positive, why did the initial euphoria fade so dramatically by the close? That's what takes us into the deeper sector analysis. That structural question, why the fave is absolutely central to understanding the market on December 10th. The EOD report showed these massive intraday ramps, yet the broader weekly market digest summary for the full close shows a critical slowdown.
A huge slowdown.
The Dow Jones actually finished the day declining. It was down 0.4%, and the S&P 500 closed in a slight decline at minus 0.1%. Where did that 500-point rally go?
It was cannibalized by rotation and profit-taking. To see the Dow turn negative after a 500-point surge tells you that institutional capital was simultaneously celebrating the cut and exiting positions it deemed overvalued or, structurally weak.
Okay, before we dissect that weakness, let's just re-emphasize the positive structural sign, which was that improving market breadth.
Yeah.
We mentioned the Russell 2000 outperformance. It was up 1.32% versus the S&P 500 ETF, SPY, which gained 0.66%.
And this is the healthiest sign for a bull run right now. Small caps, the IWM, they're highly sensitive to 2 things: domestic economic growth and, critically, credit availability.
Right.
When large tech stocks run alone, often through these massive inflows into just a handful of names, it's a narrow, often unstable rally. But when small caps confirm the move, it tells you institutional capital is betting on the underlying economy, and that credit conditions are easing for smaller firms.
So it signals the market is pricing in that preferred soft landing plus gentle easing scenario.
And that's the narrative it supports.
But wait, I have to challenge that narrative a little bit. If small caps are so highly leveraged to domestic credit, doesn't their strength kind of conflict with the 9-3 Fed split we just discussed?
That's a sharp observation.
I mean, if the Fed is so internally divided, shouldn't small caps be worried about instability and tightening conditions? Isn't the market already calling the Fed's bluff on future tightening?
It is. The market is calling their bluff on any immediate tightening. That small cap ramp is a bet that the dissenters will lose and that the doves will continue to lead the path toward further easing in Q1 and Q2.
So it's confidence vote against the hawkish minority.
Absolutely. However, that contradiction is precisely why we saw sector decay elsewhere, particularly in financials.
Okay, let's pivot right there. The sector decay. While the initial Fed action implied lower rates, which you'd think would help rate-sensitive sectors,
You would think.
the actual end-of-day rotation punished the most sensitive sectors first. Financials showed the largest decline, down a staggering 1.4%.
It's a highly counterintuitive move on a rate cut day. The driving force was bank margin compression. Banks make their money on the spread between what they pay out on deposits, which is short-term, and what they earn on long-term loans. When rates fall quickly, that net interest margin, or NE, it compresses.
And the report specifically flagged guidance warnings.
Yes, likely from major component banks like JPM, which triggered heavy selling across the whole sector. It pulled down peers like Wells Fargo and Berkshire Hathaway. This immediate structural anxiety about profitability, it completely overshadowed the broader macro optimism about easing credit.
So the market essentially traded the long-term impact on profitability over the short-term relief.
Yeah.
What about healthcare? That sector also pulled back, declining a solid 1.0%.
That was classic institutional housekeeping. Healthcare stocks, especially the giants in the XLV ETF like United Health and Johnson & Johnson, they had significant runs earlier in the year. The Fed announcement acted as a perfect high-liquidity catalyst for institutional traders to just lighten up, lock in their gains, and await concrete earnings confirmation in the new year. It wasn't structural fear. It was just disciplined profit-taking.
Okay. And contrasting that weakness, we saw a powerful strength in a classic defensive value play.
Energy.
Yes, energy, represented by names like Exxon and Chevron, outperformed all sectors. It posted a 0.7% gain. And this is fascinating because it signals diversification away from purely growth-oriented assets. So what was driving it?
A few things. Geopolitical risk in the Middle East, heightening oil price uncertainty, strong fundamental cash flow generation among the supermajors, and of course the appeal of their high dividend yields. It basically functions as a defensive value play that performs well both in an inflationary environment and when the broader market is volatile. Institutional funds are using energy to hedge their tech exposure.
And technology itself, which drove the Nasdaq Composite to that slight 0.1% gain, it wasn't the roaring leader we often see.
It wasn't the narrow leader, and that is the key to interpreting the day's health. This confirms the rotation we were just talking about. Capital is moving into under-owned cyclicals, into defensive value like energy, and into infrastructure components that are playing catch-up to the massive valuations we've seen in the core AI giants.
So the mood is liquidity-friendly, but valuation-conscious.
That sums it up perfectly.
And just to round out the decay, industrials were down 0.7%, with weakness in giants like Deere and Caterpillar, and real estate declined 0.6%. This mixed scorecard, the Dow down, the S&P barely negative, the Nasdaq barely positive, it just perfectly captures the day's underlying theme.
Macro relief fighting intense sector-specific anxiety, all driven by profitability concerns.
And that anxiety is reflected in the technicals, right?
Oh, absolutely. The technical barometers are flashing warning signs. We saw the volatility index, the VIX, finish elevated at 16.93. That's up 1.6% on the day.
Which is a direct contradiction to the perceived safety of a Fed rate cut.
Exactly. It means traders were actively buying insurance against downside risk. It's a sign that despite the headline relief, deep uncertainty persists about the structural economy.
Okay, so let's dive into the core engine of the recent market run. The mega caps, the names that form the structural spine of the TKI framework. Now this framework, for anyone new to it, is the KAMBUF Reserve's short-cycle tactical strategy that leverages volatility and relative strength in the highest quality names. And on a day where the overall market absorbed that Fed cut and the S&P was up at its peak, the performance of these heavy hitters was, well, it was surprisingly mixed.
Their movement is always interpreted as the market's long-term conviction in the AI supercycle. So the divergence we saw was incredibly instructive. It confirms that the rally wasn't about index manipulation, it was about genuine capital rotation.
The biggest surprise for me was the decline in the major AI anchors. The names that have defined the last 18 months. Microsoft, MSFT, which had just ripped over 10% in the last quarter alone, was down significantly. It dropped 2.77%.
Sure drop.
And NVIDIA, NVDA, the quintessential AI supremacy play, had a slight pullback of 0.70%. And Meta declined 1.07%. These are all substantial reds on a day with massive intraday green candles.
The reading on Microsoft is just pure high-volume profit-taking. When the market gets a liquidity event like a rate cut, institutions use that moment of maximum buyer enthusiasm and price strength to offload their highest-performing assets. They lock in gains and redeploy that capital.
So it's not a fundamental rejection of Microsoft's AI strategy.
Not at all. It's tactical management. And NVIDIA's volatility, well, that's understandable given the intense hype and valuation. A slight pullback there just means traders are respecting the stock's stretched positioning.
Okay, so if the massive AI winners were red, which mega caps stepped up? Who carried the index to its near-record highs and proved that the breadth was real?
We saw 4 names that printed what the report calls clean risk-on candles. They showed true relative strength, or RS, inside that bullish macro move.
First up, Amazon. AMZN had a very strong move, up 1.65%.
AMZN is a dual threat in this environment. It's leveraged to the consumer spending narrative, the hope that easing rates will boost retail, and, maybe more importantly, it's leveraged to the essential AI infrastructure spend via AWS. When the market is confident in the economy and in AI growth, Amazon is a mandatory buy. It's a broader bet on that soft landing.
Apple, AAPL, participated steadily with a 0.53% gain, continuing its push around that staggering $3 trillion plus valuation.
Yeah, Apple is often treated as a flight to quality within the tech sector. It's just less volatile than the pure AI plays, so it offers stability and that massive global distribution. When the market wants safe, high-quality exposure, AAPL benefits.
Tesla, TSLA, jumped 1.39%. This name confuses a lot of people because its fundamentals are always contentious, but it always moves hard on macro news.
That's the definition of a high beta squeeze higher. For you, the listener, beta measures a stock's volatility relative to the overall market. High beta stocks amplify the market's move, and TSLA is the trader's favorite macro beta vehicle. When risk appetite returns fueled by a Fed cut, TSLA tends to amplify that move because of its high short interest and its massive retail following. It's a volatility play, not a pure fundamental investment in this context.
And finally, Google. GOGL had a quiet but confident day, up 0.97%.
Google continues to impress with quiet leadership across AI, ads, and cloud themes. It wasn't headline-grabbing, but it demonstrated solid institutional participation and conviction. It confirms that cloud spending and foundational AI adoption remains robust.
Okay, so let's apply the professor's read here, as the report calls it. When the overall index is bullish, but Microsoft, NVIDIA, and Meta are all red, what does that tell us about the longevity of this bull run?
It tells us the bull market is diversifying, it's maturing. This confirms that the breadth was absolutely real. The market wasn't relying on a gamma squeeze on a few semiconductor stocks.
And for the learner, a gamma squeeze.
Right. That's when options market makers are forced to buy huge amounts of stock to hedge against extreme short-term moves. If the index had relied on that, the rally would have been unstable. Instead, capital was actively rotating out of those concentrated high-momentum leaders and into the broader market, into the more economically sensitive mega-caps like Amazon and the cyclicals we talked about earlier.
So this divergence is the definition of sell some winners to fund the rest.
Precisely. It's normal, healthy capital management deep into a sustained upcycle. The underlying AI supercycle narrative is still intact. These 7 names still form the vital spine. But the market is demanding that capital finds better value in a risk exposure among the supporting infrastructure and the economic beneficiaries.
And the TKI strategy demands that you respect this short-term digestion phase and don't just chase the names that printed red candles.
We have to respect the rotation.
Okay, moving away from the mega caps, let's look at the broader technical health of the market, which flashes some serious caution flags for you, the active trader. The market is giving us some pretty conflicting technical signals.
And that conflicting data starts with the VIX. We already noted the volatility index was elevated at 16.93, up 1.6% on the day. For context, a truly relaxed, confident bull market often sees the VIX down below 13. When the Fed cuts rates, conventional wisdom suggests volatility should drop dramatically.
But it didn't. It went up.
It rose. And it rose because, despite the macro relief, investors are actively hedging. They're insuring against downside risk. It suggests that while the headline Fed news was good, institutional players are still profoundly uncertain about future economic growth or the stability introduced by that 9.3 descent. This is not the behavior of a completely relaxed market.
And compounding that caution is the volume divergence. Trading volume was just 14.5 billion shares, which is significantly lower than the 20-session average of 17.34 billion.
And this is a critical point for anyone evaluating the strength of the rally. Lower volume suggests a consolidation phase, not a full breakout confirmation. The Fed cut likely prompted aggressive short covering and some quick programmatic buying, but there wasn't massive, sustained institutional conviction flooding into the market late in the day, especially once that sector rotation began.
So for you, the active trader, low volume like this means don't fully trust the headline moves.
Exactly. The heavy institutional belief simply wasn't there to sustain a clear multi-day breakaway trend.
Now let's drill into the specific movers, because this is where speculative and institutional capital leaves its clearest footprint. Let's start with the most active stocks by volume.
High volume signals where the money is actively moving, and we saw a clear bifurcation here. High-quality, large-cap institutional plays right alongside low-cap, high-risk speculative names.
On the institutional quality side, we saw AVGO, Broadcom, with 24.5 million shares, Walmart with 24.3 million, and ExxonMobil with 23.8 million.
And this confirms where the smart money is accumulating. Semiconductors with Broadcom, resilient retail with Walmart, and energy strength with Exxon. These are high-quality names that investors are adding to their long-term portfolios.
But the very top volume leaders were penny stocks. DNN, Denison Mines, with 40 million shares, and iBio Inc. with 38.5 million.
And that intense volume in low-float, low-price stocks is a classic hallmark of intense retail speculation. It's often fueled by short-term momentum or social media hype. And while these names can offer massive percentage gains, they are highly volatile and they pose significant risk. They're a sign of excess liquidity just looking for the cheapest, fastest thrills.
Speaking of thrilling, let's look at the extremes, the top gainers and losers. This section of the magazine report is a mandatory risk assessment because these moves really illustrate market irrationality.
Yes, the extremes are not models for investment. They are warnings about momentum. For example, Beasley Broadcast Group, BBGI, soared an unbelievable 256.79% in a single day.
Wow.
And Heartbeam surged 57.05%.
A move of over 250%. That's not trading. That's rocket science. You could have made or lost a year's tuition on that in one afternoon. What was the catalyst there, and why is this an immediate risk alert?
Well, BBGR's specific catalyst was likely either a tiny low-float situation being squeezed or maybe a major unexpected asset sale or regulatory approval. But regardless of the news, the trading alert from the KAMBUF Reserve is crystal clear. Extreme gainers warrant extreme caution. These moves are typically unsustainable and incredibly volatile. The risk is that you enter near the peak and the stock reverses just as quickly, resulting in devastating losses. These are for specialist day traders only, not for long-term investors or TKI participants.
And then there's the disaster zone, the top losers. The losses here often indicate critical financial distress or imminent collapse. Work Medical Tech Group, WOK, collapsed to 96.56%. And Agape ATPC, fell 94.84%.
The risk warning here is perhaps the most important takeaway for capital preservation. When a stock collapses 96%, it often signals insolvency, massive earnings restatements, or regulatory failure. Trying to catch a falling knife that has dropped 96% is the fastest way to wipe out your capital. Unless you are a corporate restructuring specialist with insider knowledge, these are securities you must rigorously avoid. They demonstrate the power of negative feedback loops in a volatile market.
Okay, finally, let's check the signals from non-regular trading hours.
Yeah.
What did pre-market and after-hours activity tell us about institutional positioning going forward?
Pre-market showed a really interesting thematic focus. GE Vernova, GEV, surged 10.55% pre-market. That indicates strong investor interest in clean energy and industrial spin-offs, a theme that aligns with that defensive tilt we saw in energy and utilities.
In utilities like Fortis, FTS also showed pre-market strength.
Yep, signaling that institutions were preemptively positioning for caution.
After hours, we saw strength in key design software names like Synopsys, SMPS, up 3.85%, and Cadence Design Systems, CDNS, up 2.36%.
This is a critical forward-looking signal. The after-hours strength in design software suggests a positive forward outlook for the entire semiconductor and tech ecosystem, which actually contradicts the intraday Microsoft and NVIDIA weakness.
Interesting.
It implies that while traders took profits in the AI anchors during the day, the institutional appetite for the underlying infrastructure and design tools, the picks and shovels of the AI gold rush, remains incredibly robust. This gives the growth story confidence.
And conversely, we saw after-hours weakness in CyberArk, CYBR, and Biogen, BIAB.
Those drops are typical. Profit-taking or disappointment after market-moving news. For example, CYBR's decline might suggest rotation away from some cybersecurity names that ran really hard in Q4, while Biogen's drop could be a post-earnings adjustment or specific trial news. These after-hours moves often act as early warnings for the next morning's open, reflecting high-frequency trading reactions to fundamental updates.
Okay, now we translate this avalanche of data, the Fed cut, the rotation, the volatility, the diverging megacaps, into actionable strategy. This is the core of the KAMBUF playbook, particularly for those of you utilizing the short-cycle TKI framework.
And remember, the TKI core cycle is built on disciplined timing. Enter Monday or Tuesday, exit Wednesday p.m., targeting about a 1.5% gain with strict stops. The post-Fed day was the ultimate stress test for that discipline.
So the tactical read for Wednesday was that the post-Fed ramp, that immediate 0.7% S&P surge, was a gift for harvesting.
Absolutely. If you were holding a TKIF trade in a name like TSLA or Amazon that popped, 1 to 3% on the news, that window was your exit. You scale out or you lock in your profit per the 1.5% rule. The critical instruction from the report was this: do not loosen your stops.
Why not?
Because the VIX was elevated at 16.93. A liquidity gift is not a reason to abandon ruthless risk management. It's the time to enforce it.
Got it. So looking ahead to the next TKIF entry window, the report provides a clear shopping list based on Wednesday's performance. First up, the green zone priority list, the stocks showing clear relative strength.
These are the structural leaders you want to be accumulating on pullbacks: AAPL, AMZN, GOGL, and TSLA. They all prove their ability to attract capital during a risk-on event. They have deep institutional support and clean price action. We also include IWM components, smaller caps that confirm that risk-on tone, but only if the liquidity is adequate for the TKIF short cycle volatility.
And then we have the yellow zone caution list, MSFT, NVDA, and Meta. These are still the most powerful AI names, but they were red on a green day.
And that tells us they're in a short-term digestion phase after heavy inflows and a lot of hype. The guidance is clear. Demand deeper pullbacks before entering, and if you do enter, size smaller. You don't abandon the AI leaders, but you have to respect the short-term flow out of them. Trying to catch Microsoft after a 2.77% drop without confirmation of support is just reckless in this environment.
Let's move to the detailed investment recommendations, looking at the top 5 stocks with optimal spread for the broader current week. This list seems to balance growth and defense.
It does. This list is built to protect against volatility while still participating in structural growth. It reflects the strategic diversification that institutional capital is taking.
Starting with Broadcom, AVGO. Current price is $406.29. Target range, $395 to $420.
The thesis here is clear: conviction in semiconductor infrastructure. AVGO is trading right near its 52-week high of $407.29, which signals massive institutional demand. That's driven by its high-margin software segment and its key role in connecting AI ecosystems. Because it's extended, the instruction is tactical: buy on dips to $395 or when it consolidates above $400. The proprietary KING-KAMBUF rating gives it a 4.5 out of 5 on conviction. The risk is moderate because any large chip sector correction will hit it hard.
Next up, Walmart, WMT. Current price, $115.06. Target range, $112 to $120.
This is a classic defensive play that thrives when the consumer is under pressure but still spending. Its thesis is retail resilience, consistent dividends, and defensive positioning against potential economic turbulence. It has consistent institutional interest and a low-risk profile, making it suitable for conservative accumulation near the $112 to $114 support level. It provides crucial portfolio ballast.
Then ExxonMobil, XOM, current price, $118.25. Target range, $115 to $122.
This is pure energy sector strength. It's fueled not just by geopolitical risk, but by strong dividend support. It's currently yielding around 4% in consistent free cash flow. XOM is near its 52-week high. It offers a low to moderate risk profile, and it provides a hedge against inflation, a scenario that those 3 dissenting Fed members are explicitly worried about. The accumulation target is around $115.
And Fortis, FTS, the defensive utility play, with a $50 to $56 target range.
FTS is the ultimate safety stock. It showed pre-market strength, signaling its value as an economic downturn hedge. It's a regulated utility, so it offers predictable revenue and a low-risk profile. It's ideal for capital preservation when volatility is elevated. It acts as a stable anchor against the high beta volatility in tech.
Finally, we have to look at the high-risk, high-reward day trade opportunities, and these require extreme caution.
These are strictly for the advanced learner, the one with an ironclad discipline for stop losses. The report details tight risk-reward ratios, typically 1 to 1.4 up to 1 to 1.6. Take IBO Inc. It showed a massive 46.85% gain with huge retail volume. The entry is very tight, $2.80 to $3.10, with a target up to $4. But the stop loss must be set at $2.40. You have to honor that stop, because if the momentum fades, that 46% gain can be reversed in an hour.
And iRobot, IRBT, is another one, a 35.41% daily gain with 74.4 million shares traded.
The rationale there is likely a combination of short squeeze mechanics and maybe some institutional accumulation on a potential merger catalyst. The entry points and targets are aggressive, but the risk-reward is favorable for a day trade with a hard stop 10% below your entry. These are volatility capture plays, not investments you hold for 2 quarters.
To wrap up the playbook, let's look at the broader strategic buy-sell signal breakdown. What's fascinating here is the high-confidence buy signals in the mining and gold sectors, CGAU, AEM, and Newmont, NEM.
This is strategic genius. Gold is viewed as a hedge against two major risks: currency devaluation stemming from continued easing and persistent inflation that the Fed might lose control of. When the Fed starts easing, even gently, it often signals structural economic concerns that favor hard assets. These mining companies offer leverage to the gold price while providing a tangible asset base.
So they offer a strong hedge against the paper risk of the technology names.
Exactly, and their valuations are currently pretty reasonable.
So the top 10 recommended buys fundamentally reinforce this dual strategy that's necessary for this late-stage, liquidity-managed market. Buy defensives like Walmart, Exxon, and Fortis for stability, and high-quality growth like Broadcom, Apple, and Amazon for momentum.
And critically, the strategy summary stresses discipline above all else. Accumulate only at technical support levels, use hard stops 5 to 7% below entry religiously, and exit positions if they don't move within 3 to 5 days. In an environment where the Fed is divided and volatility is high, your edge is entirely rooted in tactical discipline, not hope or prediction.
So to synthesize the entire day's reports and the insights from the KAMBUF reserve analysis, we come to the professor's closing lens.
That's right. The crucial takeaway is this: you are currently trading in a late-stage, AI-powered, liquidity-managed bull market.
That summarizes the environment perfectly. Late stage because we're near all-time highs and seeing this capital rotation, AI-powered because those names remain the structural spine, and liquidity managed because the Fed just intervened. They extended the party.
But signaled caution with that 9-3 split.
The crucial insight here is that the market is giving all these mixed signals, strong breadth in small caps, but sector decay in financials and a high VIX.
Therefore, your edge is not prediction. You cannot reliably predict the next Fed descent or the next geopolitical spike that fuels ExxonMobil. Your edge is discipline. Strict position sizing, hard exits, and preferring structural leaders on a pullback while avoiding the laggards on hope. The market is rewarding ruthless risk management right now.
This was a data-rich day, featuring some truly surprising facts we had to unpack. That extremely rare 9-3 Fed split, the fact that major AI winners like Microsoft were red on a broadly green market day, and those extreme movers like BBGI surging over 256%. It demonstrates the speculative frenzy bubbling just beneath the surface.
Those conflicting facts just highlight that this market requires constant vigilance.
Which leads us to our final thought for you to mull over. Given that the Fed just extended the life of the bull run by easing, yet the committee split signals profound caution. And the capital rotation is moving heavily into defensive and value sectors like energy and utilities. The core question is this: does this increase volatility, the VIX at 16.93, and the clear defensive rotation mean the market is preparing to aggressively capitalize on renewed growth before it gets too expensive? Or is the market actually preparing its defenses for the inevitable moment when this liquidity support eventually fades, suggesting extreme caution for the year ahead? Keep those questions close and your stops even closer.
Keep learning and keep asking the right questions.
Thank you for joining us for this special deep dive into the Reserve of KAMBUF Financial News and Reports Magazine, Weekly Market Digest and Investment Analysis. Date, December 10th, 2025, Weekly Market Digest Edition, Daily Report. We'll catch you next time right here on Beyond the Comfort Zone, Talking Shit with King Kambo.